Have you heard? A legendary investor just made a massive bet. We're talking almost $1 billion on paper, and his target, the hottest sector in the market right now, AI stocks. He thinks they might be headed for a serious downturn. Now, this isn't just anyone. This is Michael Burry. If that name doesn't ring a bell, his story definitely will. He's the real-life hero from The Big Short. The guy who saw the 2008 financial crisis coming when everyone else was blind. When he makes a move, the entire financial world stops and listens. So, what did he do? He didn't sell stocks directly. Instead, he bought what are called put options. Think of it as a bet that prices will fall. When the stock goes down, the value of his options goes up. The headline screamed about a $900 million bet against the market. Now, the real money he put at risk was much smaller, probably just a few million. But the signal it sent was loud and clear: caution ahead. And then something interesting happened. He went quiet. Burry deregistered his hedge fund from the S. In simple terms, this means he doesn't have to publicly disclose his trades as often. It gives him more freedom and privacy. When a famously smart investor decides to operate in the shadows, it usually means they're preparing for turbulence and don't want others copying their every move. So why is he so cautious about AI? Let's look under the hood. Some of these AI giants are spending absolutely eye-watering amounts of money, billions of dollars, on things like servers and data centers. But due to some clever accounting, these huge costs can be delayed on paper. This makes their current profits look much bigger and healthier than they might actually be. There's also a phenomenon some are calling circular money. Imagine Company A invests in Company B then. Company B turns around and uses that exact money to buy services from Company A on paper. It looks like both companies are thriving with new business and investments. But in reality, it's just the same pot of money going around in a circle, creating an illusion of growth that might not be sustainable. Now, for the most important question, should you, the average investor, try to copy Michael Burry? Should you sell all your stocks and try to time the market? For almost everyone, the answer is a firm no. Market timing is incredibly difficult, even for the pros. You risk selling too early and missing out on future gains, or you wait too long and buy back in at an even higher price. You miss the growth. You miss the opportunity. There's a much simpler and historically more effective approach. Stay invested for the long term. Look at history. Markets go up and markets go down. This is completely normal. We've been through wars, financial crises, and global pandemics. And yet, over the long run, the market has consistently trended upwards. Why? Because human innovation doesn't stop. Companies create new products, they become more efficient, and they grow their profits over time. So, what should you do with this information? It's not about panicking, it's about being aware. The best strategy is to have a solid, long-term plan that you can stick with. Figure out an asset mix that's right for your goals and risk tolerance. And then, crucially, stick to that plan through the good times and the bad. The single most important factor in your success isn't trying to predict the future. It's controlling your own emotions and avoiding impulsive decisions driven by fear or greed. Think of Burry's move not as a prediction to be copied, but as a valuable reminder to be careful and do your own research. Understand what you own and why you own it. Don't get swept up in the hype. Think long term. That's not just how you survive market swings. It's how you truly win as an investor. Thanks for watching. And don't forget to like and subscribe for more insights.